Good afternoon, everybody. Welcome to the TraderMerlin Show. It is your Wednesday edition, a special Wednesday, because today I have the pleasure of getting to interview and hearing from one of my good friends, Mr. Larry Jacobson. And I was trying to figure out a nice graphic to do for today's show, and I was like, well, maybe I could use AI and generate a graphic of Warren Buffett reading a book, and then I was going to have looking over his shoulder, I was going to have a picture of Larry Jacobson, but I couldn't get a good animated one of Larry Jacobson. They all look terrified, but here's the graphic for today. A page out of Warren Buffett's Playbook with Larry Jacobson, and that is an AI-generated picture. Pretty damn good, I must admit, by the way. Thank you for the AI for that one. No, this is not a Raiders logo. This is green, I think. This is a green shirt. I guess that's for the Eagles. That's the shirt I've got on there, Tomasina. Anyway, we've got Mr. Larry Jacobson joining us today, so I will say hello. Larry, how you doing, my friend?
I'm good, buddy. Just kind of doing my final prepping for you, but everything's all good for today. Glad to be here. I know we had to pull it off at first. I think I could make it, and then it turned out that the meetings were changed, so I'll be here.
Yep, as you guys know, I got started a little bit late here, but pull your camera down just a hair. You're sitting right at the bottom of my screen, just a tad. There we go. Wait, perfect. Yeah, we were actually, Larry had some meetings. I wasn't sure whether we'd get him on the program today, but lo and behold, we got him on the show. So thank you for taking the time to come on. I appreciate that. What's new in your world, my friend?
A lot going on, just markets, a lot of news happening right now, a lot of people trying to decipher what's going on. And I figured, there's a little silver lining that I like to go over. This is why I thought it'd be good, because usually I find one, maybe two things a year. And I found three things I've liked so far in the top of the year, which is starting to make me feel that we might be down, at least for now, in an area where we can start to maybe acquire some longer term assets at this point. And so I don't need to wait for a full pullback. I just need to find a price that I like and I want to own the company at. And so I thought we'd go over some kind of fundamental things. I can share some of the things. And then the big reveal at the end, I only really share this with you, Merlin. So for educational purposes, we can show the portfolio that you and I have been looking at week after week, going all the way back to 2015. So I have that ready to queue up when you're ready for that.
Fantastic. And by the way, I did enjoy doing that workshop with you on Tuesday. That was kind of fun, having everybody in there and all the OTA instructors. It was good. Good to see our forecast for the year.
Absolutely. So you want me to share? You want to start off with a question? How do you want to do this?
Whatever you like. I got one question that was sent in, but we didn't have time to get to it. It was about a specific fundamental analysis of a company, which we can do later on. So if you guys in the chat, I know we've got a fairly regular group. We might have some new people in there. If you are new, the easiest thing to do is when you type in a question to the chat, put some question marks before it, just so I know it's directed to us, and then I will get to those on the air. So I will let you take the lead here, Larry, and walk me through what you're looking at, and maybe for people who are new, talk a little bit about the methodology that you're going to be applying today, which is kind of that Buffett playbook approach, as the image would illustrate.
Yeah, what I'm going to share here, let me share my little PowerPoint. Give me 1 second to bring it up here.
PowerPoint.
Just a couple of slides. I introduced them yesterday when it was time here. Hold on a sec there. I just got to turn off the volume.
This is started screen share. We're not seeing anything.
Okay. I am sharing right now. Are you not seeing it?
I got it. I see your 4 slides.
So is that now coming into view?
Yes. Got your 4 slides.
Okay,
yep.
Perfect. So what I want to start off with everybody real quickly here.
To generate more income from the
Sorry,
market.
hold on a sec.
I'm not sure what
Larry's the master multitasker. He's going to have 4 or 5 things going on at once.
So here we go. So I want to talk about these 3 forces here because I think they're very important, especially now and what's been going on in the markets. And I know a lot of people like to learn options. And especially now, if you're following feeds like I am, Merlin, you're seeing what is the flavor of the month. Can you tell me the flavor of the month in options right now?
0 DTE.
You got it. 0 DTE, which means 0 recovery time to lose all your money.
Wow. Well, so, that's certainly one of the downsides to it.
Yeah. And so at this point right now, we got to understand something, right? One important factor about anything you're going to trade is how aggressive do you want to be and how quickly you want to accomplish your goals. Now, there's two schools of thought here. There are people that feel like, I want to go in every day, I want to grab as much money as I can, and they're constantly out there looking for the greatest and new thing. The problem is that a lot of people just get seduced by people telling them how great the strategy could be, but lo and behold, no one's actually really showing them the strategy or really doing it in a way that can be what I call two words. And I look for every strategy that I would ever teach a student have to have two things: validity and reliability. When I talk about validity, there's enough there rule-wise to validate why you'd want to do this strategy to begin with. So a lot of times what I find people doing is going ahead and trying to do something they watch someone do on a YouTube video, not really understanding what they're really looking at behind the scenes. The person doing the video is usually selling something, and so they're going to keep it as obtuse as possible. And so what I want to share here is there are three things that you've got to know going into any one of your trades, be it a shorter term option trade like a 0 DTE, or you're dealing with, say, a weekly option trade that I like to do, or you're doing a more longer term option trade that you and I talk about a lot. And it's these three circles here. And so most people don't realize that there are three forces that are happening. They're usually used to two of them. One, price is either going to move or not move on a chart. And two, there's a time component to trading options. Well, probably the most important one of all three of these is volatility. So if I were to put the typical what, where, how, when, why that you learned in journalism, I can break this down by saying, where do you want to enter this trade? So we teach our students the core strategy, where we believe markets are more likely to turn. Now, I've been listening to some audiobooks lately. I've been watching some people online, and they keep saying over and over again, right? You can't time the market. Now, I chuckle with that because in their mindset, and some of yours is, no one hopefully in this room is trying to call tops and bottoms. That's silly. But to say that you can't time a market to know when a market's been going up and all of a sudden it's going to reverse and maybe start going the other direction, that's just silly. That tells me that they trade one-trick ponies and don't really understand how price on a chart tends to work. Or there are people out there that only say, all you do are long calls and long puts. Every strategy is there. And I've even seen broker platforms that don't have enough resource to do what you probably want to do. So the first thing you got to realize is, where are you on a chart? Where is the amount of time that you want to be in this trade? And what makes the most sense? So like a 0 DTE, for example, you can do it in one of two ways. There are people that look for the breakouts because of what we call the gamma effect. And I'm just going to explain that to the audience real quickly, Merlin, is that one of the things that we don't teach in our program is because we don't teach our students to go all the way to expiration. Number one, there's no need to if you're doing things the way that we're instructing you to. But if you do, on the last day of expiration, you have a Greek called gamma. A Greek called gamma. And all gamma is a gas pedal for another Greek called delta. And what you have to understand is that at the time of expiration, and let's say I buy a 50 call, which means that my strike price is at 50. I have the right but not the obligation, if I choose to exercise that right, buy the stock at $50 a share. If at time of expiration we're at $50.01 or higher, we are what are called in the money, and the delta will be the equivalent of 1 out of 0 to 1, meaning that for every contract, it's the equivalent of me buying 100 shares of stock. If it's at $50 or less at time of expiration, then what we really have here is what's called out of the money, and the option is worth 0, and the delta is 0, as in you now control or own 0 shares. What the gamma does on expiration day is the gas pedal that pushes the delta either to 1 or to 0. So there's a strategy out there that some people are doing to see if price will move fast enough, farther enough in one day to generate enough profit for them to make it worthwhile. Another camp is, well, why do I want all that effort to have price have to move? What if I find good areas on a chart and I don't believe price is going to get there in that period of time? Then they could do what's called selling premium. and as a result, collect premium. And if it doesn't do anything throughout the day, it goes down to zero and expires worthless. Me personally, and again, I can only speak to myself, I prefer the credit strategy because there's just, let's face it, less work to be done. And again, if you're somebody that's looking for a specific amount of money, granted, you will always make, from a rate of return perspective, more money when you go long an option than you'll go short an option, but you have more risk going long. Risk in that price has to move to be profitable. So right off the bat, if you're looking to trade options, you need to understand how movement on a chart works. Secondly is the when factor. Well, if you're in a zero DTE, that means you're buying it today and it's expiring the same day, which means that if you're wrong, there is no recovery time. And if you're buying options and the price for that day doesn't move, then you basically have burnt through all your premium. And this only works if you can find what I refer to as inexpensive or cheap options to trade. So I don't want to be doing a $5 option that comes out to be $500 a contract that's only going to expire and go to zero anyway unless price really moves. Versus I might have a spread that has $500 of potential buying power risk, meaning I tie up $500. That's the most I could lose. But if it doesn't move and doesn't do anything, it goes to zero and I get to keep the premium that I collect. So it's very important before you just start jumping in and trying all these things in the markets, you've got to simulate. And that's the second piece. First was validity of understanding these rules and it makes sense. The second is reliability. It should be reliable that I can put this trade on the majority of the time and should be profitable. Doesn't mean I'm going to break the bank. But at the end of the day, what you have to remember is that your goal here is not how much money you can make. It's how much money you get to keep. And then finally, with volatility is, you know that it's a one-day option. Is it around an earnings announcement? Is there some news that's going to happen in that day that you have to look at and see, will that be enough to move price? Now, the closer we get to expiration, the volatility becomes less of a factor. Why? Because there's less time for volatility or the markets to really swing as great as it would be if, let's say, we were going all the way out to, say, 90 days or more. So once you understand these three factors, then it makes sense why I would say to you, Merlin, or anyone listening, okay, if I'm going to be much longer term, I'm going to be less concerned about what's happening in a week or a day. More concerned is this company going to generate enough return to keep the investors happy and keep their monies in the market for that particular stock? Mm-hmm. The second thing is, hey, I want to be in there for 1 week or less. And as you know, I've been teaching this weekly Trading Weekly options class for Online Trading Academy now for almost 2 years. A lot of students like it. It's pretty consistent. It looks to generate about 5% a week. So it's not a very aggressive strategy, very conservative.
Hold on. I got to stop you right there. Hold on. Yep. Before you say, if we look at the average rate of return for the markets, the average rate of return per year is 8%. So I think a lot of people would look at that and go, the hell are you talking about conservative? 5% a week, that's pretty up there. I'm looking at a couple different strategies where I get 1% a week. You're looking at, 4% a month. You're looking at 48% rate of return per year. I would argue that 5% per week is pretty aggressive.
Oh, here's the thing. For people who are not going to just need 1%, some people need more than that. It's safer to me in the strategy I'm teaching than trying to go in there and try to get in right before the end of a day and you wind up just getting blown out of one side or another. So when I say conservative, it means, in my world, less stress. You're not going to be sitting there pulling your hair out like a lot of people do when something goes wrong and there's virtually no time to recover. So that's kind of my version of why I say more conservatively. To some people that need 10%, 5% is going to seem pretty conservative to them. So you, my friend, who likes the 1%, that works because of the account size you're trading. To others, 5% when you start off, especially at one contract, and you're making $25 to $50 a week, it's going to seem a little conservative as you start to build up the contract sizes. And that, to me, is the secret here. It's not about the strategy per se. It's how you manage the strategy. And where you start to see the results through consistency is as I start to grow my contract size, trading the same thing week after week, that's where you start to see the account start to grow.
Right.
So I will mention this. I think I mentioned it the last time I here. I'll say it again because it was such a mind-blowing, simple concept. Is when someone asked Warren Buffett recently, Warren, what you do doesn't seem that difficult. It seems pretty consistent. Why are more people not doing what you're doing? And he simply said, because people don't want to get rich slowly. So there again lies in purpose, what you're trying to do, but understand that when you start to get into zero DTE, you are in a casino at that point. You got to make sure that all those factors are working in your favor, because if volatility somehow goes against you, some news happened you weren't expecting that day, you already know time is going to be out that day, and if price doesn't move and you bought, or it does move and you sold, you've got to be prepared to take some lumps if it goes against you.
Yeah, that's one thing I wanted to just kind of quickly go over is, when you look, especially when people are saying specific rates of returns, that gets people all fired up. What are some of the, if you're looking at that approach, I'm talking maybe 5% rate of return, whatever, what is the big risk to you? What's that point where you're like, man, this could blow up in my face if it goes wrong? So I guess what I'm asking is, what's that worst case scenario in a situation like that, kind of so we can assess the reward versus risk ratio?
Well, basically, if you're going to do a credit spread, and again, it determines, let's take it from both sides. If you're going to do a credit spread, you can go into that trade knowing the most you can lose is the difference between your strikes. So if you're doing a credit spread, your long and short strikes less the premium collected. So you can go in there. That's the worst case scenario. But as I teach my students, I call them happy losses, where you can set up a rule that says, if it does go against me, I'm not going to wait for it to pummel me. I will get out much sooner because, again, I'm going to have losing trades from time to time. It's the losses being smaller that makes all the difference. And again, 75% of the outcome is in favor of the seller, right? Because if price, let's say I'm doing a bear call spread at, expecting price to go lower. Price drops, makes me money. Price goes sideways, makes me money. Price even goes higher, but doesn't go a penny above my strike, makes me money. So 1/4 of the outcomes, or 25% of the outcomes, is what I'm really managing when I do credit spreads. When you're a buyer, however, it's the opposite. Because when you buy, yes, you have a predetermined amount that you're going to pay in premium. Worst case is the premium that you're going to lose. But here's the difference. If price doesn't move, then you're stuck, because it has to move a certain amount of time or price for you to be able to make profit on that trade. And so there are different ways that you can minimize it, different strategies you can do, but it comes down to whether or not you are managing your money well. And that's what people get sucked into. This idea that I can make money immediately today without thinking, oh yeah, but you can lose a whole lot more if you were wrong, And that's why in my focus class, we get together, and what I do is people started to want to learn how to do weekly options. In my mind, it's 5 days or less. So for example, yesterday, or actually Monday, I did a zero DTE because I knew the CPI was going to come out on Tuesday. So I'm going to be teaching my students this Saturday what I did, how I did it, and most importantly, why I did it. See, that's the difference here. We don't really get the why, do we, Merlin?
Right.
We get a lot of how, but not why. So that's going to be a big factor because a lot of them want to know what's going on. And another thing that I did this week, which I don't do that often, is an iron condor. And I'll explain why I chose that. Usually, I prefer just to do spreads. So there are times that you can change things up. But if you don't understand why you're doing something, it makes it very, very difficult, to be able to do this.
So
and
let
unless
me
you understand how to do that, it becomes difficult.
Absolutely. So a couple good points here. Robert says, is this an OTA class? Yes, Larry teaches, it's a focus session. We'll talk more about that here a little bit later on. Tom said something interesting, and we'll clarify the semantics here. He says zero DTE or day to expiration is not new. Correct. It's not new, but it's become all the rage, I think is what Larry really meant to say. It's not like, oh, this is the brand new thing. it's been around for a long time. It's just
It's the flavor of the month.
It's the flavor of the month. And to keep going there, it's interesting. Tom has gone through a discovery process. He's taken many classes. He's been with a bunch of different instructors and different strategies and kind of found what works for him. I tend to agree with Tom here. He says, I do 0 day to expiration, but there can be stress. Weeklies are easier. And it's not necessarily that they're easier. It's just there's less stress on you. I prefer the monthlies, but then again, I got to wait 30 days. But it's just easy. I do once a month. I can go so far out of the money, I don't take a lot of risk. I can go weeklies, get a better rate of return, but now I have this risk is accelerated. I go 0 day to expiration. Now the risk is really accelerated because I need a decision today, and I have to really understand my strategy or I can get burned on it. So as Tom finally says here, not a casino. It is a casino for people who don't know what they're doing. For those that do understand the math and the mechanics behind options, I agree with you 100%, Tom. It's an engineered process, and that's really how we should approach it. That's why I was talking about the turtle traders was on Monday. That is an engineered process, and you can do the same thing. Apply those 6 steps that the turtles did to the option side of things and make sure that your strategy fits those 6 criteria, and you should do fine over time. Anyway.
At the same time, to Tom's point, and Tom's been a student of mine, he's been in my class, it's an engineering process if someone taught you how to do it.
Right.
Most people are out there, they're hearing 0 DTE, they're pumping away at these different courses out there or buy their program. They won't teach you how to do it. They won't tell you what they're doing. They're just going to tell you to do it because you can make money. And that's what I'm referring to with the casino mentality out there. It's no different than it was with the .coms. I mean, you mentioned something yesterday. I did a spit take, Merlin. JDS Uniphase, greatest joke in the world, got to $75 a share and then just tanked and went out. Yep. Anybody who bought that at $75 got to watch it go delisted and to 0. And yet everyone was telling you, if you're not buying these .com companies, you're an idiot. Remember those days?
I remember. I was on the floor during those heydays. That was good stuff.
That's right. So that's my just point here is that anything is possible. Just understand that these 3 factors need to be understood, or you're going to find yourself in a guessing mentality, or worse, not knowing what to do if it does go against you. And there are students that I've talked to in the past that had worked similar type of strategies before coming into the focus class, and they were stressed out and they were losing money. And you can get wiped out. You can have months of profit, and one trade can just knock you on your ass. And you've given everything else back. I don't know about you guys. I'm not in the game of wanting to trade for an entire year and having 0 or very little money in the account. That doesn't sound fun to me.
No, it definitely does not. Not for me either.
Exactly.
So with the spread, I'm going to read this question from Ganesh and see what you think about it. Ganesh says, I do spreads and iron condors, but the problem is the spread is the difference in cents. I will sell a 200 call at 4 and buy the 205 at 325. So my profit is only 75 cents per contract when the price of stock is like $199 or so.
Okay, that's the point. You're not going to make a large, that's exactly to my point. You're going to get smaller premiums if you are basically, one, putting your spreads where they should be. See, that's why I kept saying that's what I meant, Merlin, by conservative. See, someone's going, but I'm only making 75 cents. Correct. But Ganesh, here's the question. How much would you make if you started to do 50 contracts at $75 a contract? See, that's what people don't understand. In the beginning, you've got to start small and build up. As much as Warren Buffett, when he was in his teens, wanted to own millions of shares of Coca-Cola, he wasn't doing that until he learned how to do that and then how to build off of those particular allocations. So that's my point. You're absolutely right, is that you have to be willing in the beginning to take less profit to protect yourselves, and over time, through consistency and reliability, you'll be able to grow your contract sizes. And I talk a lot about that in my focus class because a lot of students want to go from 0 to 60, and I really get on them for blowing out their accounts. Number one, there's no reason to do that. And number two, you're still in the novice mindset of it's all about how much you can make, not how much you can lose.
Nice. Let's go from shorts. So obviously for those who are in the know, you understand that Warren Buffett obviously made a ton of money by buying good companies. One of the best ones he ever got was See's Candy, which I think he paid a few $100,000 for. Now it's worth $2 billion, a hell of a rate of return there. But if you look at another source of his wealth, it was selling options. So that's kind of like we started this discussion here about using options, whether you're using monthlies or dailies or weeklies or zero DTE. There's different types of ways to earn premium as a seller of options. Let's talk bigger picture now and go more of a fundamental approach, because I know that you talk about your portfolio, or the portfolio you've been tracking for years, and I've given you some grief on some of those positions, and of course I'm the one left with egg on my face. But walk through kind of moving away from the shorter term options side of things to the long-term investment. What sort of criteria are you looking for? And then your take on Buffett's approach. And then ultimately, what are you going to add to your portfolio today?
Well, this leads into the next slide. And I did show this yesterday in the symposium. So it's really worth repeating because it is a monthly chart here. So understand that my perspective when I'm looking at a company is not the same as what most people are. And that's kind of where Merlin and I really, I wouldn't say butted heads, but you remember you were kind of like, why aren't you selling this already? I am looking out not a year from now, not 2 years from now. Will this company be, one, still growing 5, 10 years from now? Will it be a market leader? Like, let's go back in a time machine, Merlin. How many of us would have loved to have bought Microsoft stock in the year 2000 for $12 a share now? Think about that, right? And nobody did, right? Because it was undervalued and people were always equating the price of the stock to the quality of a company. So the first thing I want to say to everybody is this, right? You have to understand that when it comes to what's called value investing, and I heard this once, and I believe it was Ben Graham or someone who said it, was the stock is broken, not the company. That means from time to time, stocks will fall out of favor. They're going to go out of balance from what the stock price should be trading at. If I were to basically go ahead and liquidate the entire company, how much could I raise in breaking it off and selling it, divided by the number of outstanding shares that the company has offered? That is its true, what we call sticker price, what it's truly worth. What Buffett had learned, as well as other people like Bill Ruin and people who were in that same kind of class era as Buffett from Ben Graham, was the idea that you want to buy a company that's not just trading at its sticker price, but a 25 to 50% discount of where it should be trading. That's where the fundamentals come in, because at the end of the day, looking at this chart, this is why I brought it up here. Okay. One, you've got to realize there are two different ways that you can trade options. You can trade directionally, which is price-based trading, or you can trade non-directionally, which is more time-based trading. But here's the thing that many people fall into a trap on, right? You can be buying and acquiring things. So in my mind right now, let's say that I come up with a price that I want to own the stock at. Okay, we're not there yet. And I'll ask you this question because you do this strategy all the time, Merlin. What could I do if I wanted to own the stock, but it's not at the price I want to own yet, but I'm willing to buy the stock if it gets there? What option strategy could we be doing?
It's just straight selling puts. I do it every month.
You got it. And that's what Buffett's secret was. Warren Buffett knew the price he wanted to buy something at. And so he would patiently wait. And if price didn't get down there, he would sell put options against it. And then eventually, if it hit that price, he was more than happy to take that and move on. So what I'm interested in right now is not so much this conventional trending that we're used to. It's, I don't have a crystal ball. I am forecasting, do I think this type of a company will be relevant and around in the next 5 to 10 years? And if so, how do we go about fundamentally figuring it out? Now, I'm going to share something behind the curtain that I haven't done yet in this class, and you're going to see it right now. Ladies and gentlemen, this is an actual worksheet from Bashir Chaya's value investing class that I helped him with. So what you have to first be able to do, and obviously to the right here, are where you would get all the resources and what websites to get this information to fill it in. But here's an example of one called Brown-Forman Corporation. This is not something I'm looking at. It's just an example that came out of Bashir's course. He knows the current price right now is at 65. After you do all this analysis and you're forecasting for net future value and you're discounting it back to today's price based on a lot of different factors, the intrinsic value, and the last time I was on, I gave you more of a visual of what that looked like. Right here at this point, you can see that if we sold off Brown-Forman based on the number of outstanding shares are in the company, which right here is about 309 million shares, it should be selling at around $68 a share. First question, little less than that. So it's around its what I call fair value, but it's only now selling for about 5% of where it should be. Now, what if you do these numbers on a stock that you like, and all of a sudden you see the margin of safety at 25 to 50%? Well, that gets me excited.
Right.
It tells me, number one, I found a company fundamentally that's still very strong. It's able to grow year over year. It's able to keep its competitive advantage. It's able to manage its debt. And most importantly, it's selling at a discount right now. We all say we want to buy at a discount, but yet sometimes we get too enamored with a chart that we can't really see the bigger picture here. So this is something that we now give students, and you learn how to fill this out, because here's the thing that I'm always looking for. And I mentioned this yesterday, Merlin, I know you were on there. I don't know how many of you were in that session. I call it the mighty V, like the letter V as in Victor, the mighty V. And what students should be spending most of their time learning how to do is these two things. Think about it for a moment. Imagine that you had taken our strategic investor class and you knew in January of 2008 that you should have been in cash. And you went to cash in your retirement accounts. And then in a self-directed IRA, you bought yourself some puts. Imagine the amount of money you could have accumulated had you bought puts at the all-time highs and watched that completely trash down in 2008 till March. What people then don't know what to do is the complement to the other side of the V, which is making money when the markets are dropping very, very quickly, either due to a correction or to a crash. And two, how do you take advantage of what I'm showing you all here on the screen is a company that deserves to be bought at this price, not just because it's cheap. And that became a problem for a lot of people that I spoke to around 2009. And what they were doing was buying garbage like GE, right? GE was a garbage company since Jack Welch left. Never would have made the list. Now, it made back some money, but nothing in the realm of what could have been made if you've been buying stocks. For example, like back in 2009 in March, you could have bought Amazon for $70 a share. How many of us would have kicked ourselves to have bought it? And 10 years later, or a little bit more, it was now over $1,000 a share. That's what I'm talking about. That's what Buffett's looking for. And it starts with these formulas. Now, is it perfect? Absolutely not. Do you have to make a commitment in these stocks? Yes, at least 3 years. But here's something that some of you may want to do. Not only do you find these stocks, but what if you wanted to hold it for just a year, right? You can do a leap. I can go out a whole year, 2 years into the future, and I could have bought Amazon. That gave me the right but not the obligation to buy the stock 2.5 years later at $70 a share. And I'm making this up. Maybe it was at $700 at the time. How many of you would love that opportunity to save over 2 years and then take ownership of the stock, but you only paid $70 a share for it? That's what I find is the unspoken hero of trading. Trading is fun, but investing is going to get you where you want to go. So with that being said right now, I'm going to see if there's one last thing here. I just want to bring this up for a second, Merlin, and I'm going to introduce some things here. What we've been doing aggressively over the last 1.5 to 2 years is building out a bunch of complementary courses designed for students who want to go to that next level. So for example, heard a lot of students going, I'd love to learn how to trade the right way, these weekly options. I'm teaching that class. Steve Szyminski is teaching people how to trade diagonals and calendars. Diagonals are a perfect complement to what I call a synthetic covered call. Instead of owning the stock, you can buy a leap option and sell calls against it. Mark Schlichting is teaching ratios and butterflies, fairly valued options that cost pennies to the dollar to buy. And then worst case is you lose $62, maybe even $100. A lot of people aren't taking advantage of that. Straddles and strangles, which by the way is one of the things that Jordan Matthews talks about with his 0 DTE. And here's Russ teaching you how to put these trades on around earnings. And here's that value investing piece. So what you just saw here, here is right out of this class. Then you got Sean Reed, who's taking it from premium alone, the Vega aspect of volatility. And look who's coming on board starting in March. I don't know this guy, Merlone Rothefeld, but he's going to be doing digital assets and crypto. So again, maybe 5% of your portfolio is going to be a little bit more speculative. And that's a fun place to play right now as you're doing some other things. I just wanted to bring this up right now to explain it. Now, what I'm going to do also, if we have a little time, Merlone, is I'm going to bring up the 3 charts that I'm looking at. So the very first one, it was Christmas time, right? I know that's what everybody's waiting for. Here's NTES. And I came on, I think, right after the top of the year with you. And I said, here's going to be kind of the Christmas gift, right? So look at this right now. Here is where I was acquiring. Look at the price movement monthly so fast, right? It's come back down. Would everybody agree here? And I can see chats, and Merlin, you can chime in. Did we have a nice pullback from around 140 down to around here 70? Almost a 50% pullback in the stock price in the context, which could still be a bigger what? Uptrend here, right? So I'm going to take a shot at something like that. And if I can't afford to buy the stock at the time, which would have been around, I think here, I can't remember what we actually did. I can see on my little screen, I'll bring it up shortly to all of you. But where I was looking at acquiring it, give me one sec here, I'll bring this over, was around $68, right there around the demand zone, okay? Rob's asking, where can you get the worksheet? You got to take the value investing class through Online Trading Academy. And not only do we give you that sheet, but we teach you how to fill out that sheet. So it's important to understand what each of these different things are teaching you. So this is NTES. So as far as I'm concerned right now, we're still coming up here. Now, the first thing someone's going to say to me, and I'm not going to disagree, but Larry, aren't you worried about this supply area? Sure, in the short term, but I'm not in this for the short term. I'm in it for the longer term. And based on what I've been able to determine right now, buying this stock at $68 was giving me a discount on where the stock should be trading at. Does that make sense, everybody? Mm-hmm. So you're looking at this going, man, you're putting on some risk here. Yes, but I'm paying at a fraction of what it should be bought at. And people are going to wait and wait until it gets high enough that they're going to lose. Okay, they're going to lose the opportunity.
Well, I think the key here, Larry, is, with that, if you look at that chart you got up on your screen, when it was up at 130, there's a lot of people that wanted to buy this thing at 100 or 90 or 80 or, getting down into the 60 level. Sure, we'd all like to buy this thing at a fraction of the original price. However, that spreadsheet that you have, I think you look at it creating tools and resources to help make decisions easier for you, right? And having a systematic approach. That's, again, I'm going to keep circling back to the turtles discussion we had on Monday, where there's 6 fundamental rules that they follow. And what you're doing is saying, okay, well, I look at this price chart of NTS. If it got down to 70, that doesn't mean it's a buy. It absolutely does not mean it's a buy. Yeah. He's saying, I'm going to run through this spreadsheet and say, if the spreadsheet, what does the number look like if it gets down to 70? What's my margin of error, right? My margin of comfort. What did you call it? Margin of
safety. Well, I'll give you the actual number. I calculated out at that time, the stock right then and there should have been trading at $188 a share, and I got it for $68. Guys, do the math.
Right.
Look at the discount I bought it at of a stock that should be trading at $188. And guess what? over time, the price will catch up to the fundamentals.
Should catch up. Should catch up. We never say will, but everything being equal, and if this is still a good company and those numbers still hold true, then yes, it should catch up there. Granted, you might get that outlier where something changes and there's some accounting irregularities or whatever, but for the most part, you are right. Yeah.
And guess what? I don't have to be right on every single one of them. In fact, Charlie Munger came out and said, look, Warren and I are not that smart. If we hadn't had 5 or 6 of our best trades, we'd be average traders.
Yeah.
He actually said that.
Well,
so understanding where there's value and being willing to take a shot at that. Now, by the way, maybe some of you wanted to get in at this demand zone, ride it up here, and maybe you're willing to be in this for a year. Nothing wrong with that. Maybe you couldn't have afforded $7,000 for 100 shares of stock. Okay, so very, very important right now, everybody, that I'm just giving you guys ideas here, and I will tell you what the numbers were of where it should be right now at this point. So that's where, by the way, the number I gave you, 188, should be where it should be at. If I look at its true sticker value, Merlin, how much this company, based on its fundamentals, should be worth right now?
No idea.
$375 a share.
Wow. Okay.
So think about that. Is it worth going after a $68 a share stock that should right now be trading at $376 with a future valuation in the future of $1,500 a share?
Yeah.
But you're absolutely right. You got to go through looking at the company, seeing what it's going to be doing. Is it going to be valuable in the next 5 to 10 years? So you have to understand the art of this. Yes, I like to marry the two, but it also means it needs to be taken into consideration that I could have losing trades or may take a while. In fact, Merlin was joking with me on a company called Trade Desk, TTD. Mm-hmm. Now you see it all over the place. And it was stuck at $50 a share. Remember that? All the way back in 2017. It's like, this one's not moving too much. Guess something went wrong there. And yet alone, it wound up splitting 10 for 1. And that $50 stock would have been worth right now $490 a share. So you got to think of it from that perspective. It's a different way of looking at it, but I don't lose sleep worrying about it day after day.
Well, let's talk about losing sleep. So, 2 things. Rob says, is this value investing available in the UK? Yeah, the Focus series is available globally, and it's I'm pretty sure Bashir is going to be focusing on U.S. equity markets, but you obviously can apply this stuff to what's going on in the UK. And you guys all have GAAP, which is generally accepted accounting principles, so it should be the same math being reported. The other part here, which is a good comment from Michael, you said, Larry, no problem sleeping at night. Is there any uneasiness that this is a Chinese stock? I mean, this is a Chinese company. Does that ever factor into your long-term approach? Because I personally don't trust numbers coming from any Chinese company. That's just me.
I normally will not, but they have a strong presence here in the States.
Yeah.
So they are very supported by U.S. companies. They're trading on the New York Stock Exchange, the NASDAQ. So there's some regulation with this. If it was just purely Chinese, like I don't trade Baidu for that reason. Things that I know that can be manipulated. But here, again, there's nothing perfect, but I'm going through my process. So that's the key, ladies and gentlemen. What is your process? And I'll even go back to something Tom said earlier, which is the engineering process. You have to learn how to re-engineer and decide, does this work for you? Now, there have been some good ones. There have been some bad ones. Let's take a look at another one since we have time. Yes, sir. Yes, Merlot?
Yeah, we're getting up there, though. We got 15 minutes left before it turns into an hour show, and I can't let these guys get an hour show. So
No, here we go. So here's another one I basically looked at and picked up in early February. I like Copart. This is another one that I'm looking at right now. So I can tell you that right now, its sticker price should be around $150, and it's now trading at around $70. So there's another 50% one. Now, I'm not making any recommendations to anybody to buy this. I'm just explaining this concept of I'm looking at companies right now that have the potential, based on what their fundamentals say, to continue to be good market leaders. And the most recent one I just added this week. Okay, here it is.
Drum roll. I'm getting the drum roll. This is my artificial drum roll. I don't know if that sounded on there.
Nope, didn't hear it. This is one I like, NMND. Now, why do I like this? All about plastic surgery. I'm sorry, but this is the new game in town, ladies and gentlemen. All this cosmetic surgery going on.
You say
And not
new.
just-
Have you watched any movie? Have you seen Tom Cruise or Phyllis Diller? I mean, this is not new. Plastic surgery's been around for decades. It's just been botched for years. It might be getting better, but don't do it, Larry. I don't want to see any facial augmentation from you. Please don't do it.
No, here's the thing. Ready? Here's the thing. Phyllis Diller did that because she thought she was going to get witchy poo forever on PH. What is that show? Puffin Stuff. HR Puffin Stuff, right? It didn't come to fruition, so she's kind of stuck looking like that. But no, the idea here again is that it's come down to an area that's of interest to me. Fundamentally, it looks really, really good right now. And so this is something that I've been interested in looking at. So again, these are the things that you get taught in the value investing class. I help Bashir with a lot of the content with that. And this is something, again, it's another tool in your tool belt if it's something that you'd like to see. Now, here's something that I've not brought up in a long time, and I'm going to put this out there as we did this for educational purposes only. It was when Merlin and I started to talk about this. And you remember years ago, I flew down to Atlanta to study with that guy that studied with a guy with Buffett. And I wanted to get my questions answered. And this is how the whole NVIDIA joke with us started, right from here. So this is actually as of Friday. Okay, so I'm going to show you guys as of Friday. And Merlin and I look at this each week. Here we go. So you can see the very first thing was bought November 27, 2015. It has raised about 2,600%. It's had some, and I have the little asterisks after it. It means there's been some splits. The yellow highlights mean they're not positive yet. So that means right now, out of all the ones on here, including INMD, and again, this is for educational purposes. I'm not making any recommendations, any suggestions. 70% of all these trades have been winners. So I was joking with Merlin, he'll tell you, when the crypto started to really sell off, I'm like, and so with the stock market, I'm like, this portfolio is not doing so badly. It was holding up pretty well. And right now, since then, it's about 95% profitable over the time that it started. You would have almost doubled the investment if you'd bought 100 shares into each of these companies. And again, if you can't afford the companies, you could go ahead and you could buy options and take advantage of it there as well. So the one, of course, now I'm going to really punch Merlin with is, hey, Merlin, look at Live Nation.
Live Nation.
He was like, why would you buy something like that? Well, 163% later, I'm more than happy owning Live Nation.
Well, you know what? Given what went on recently in Congress, Live Nation may be under some pressure for their fraudulent business practices and scamming actual ticket owners. People who they're screwing over fans like you and me by selling your tickets at a higher price because they know demand. That to me is corrupt, horrible business. You know, there's this social, economical governance, ESG, right? Environment, social, and governance. This is wrong from a social perspective. Live Nation should be punished by government. I hope you lose all your money on that Live Nation trade.
And they will be right after they sue the drug companies for fentanyl.
Oh, yeah, well, okay, you're right.
So anyway, guys, I just want to give you this opportunity that right now, with the markets being where they are, have a plan. What are you going to do if something does turn around? See, for me, I know exactly what I'm going to be looking at and what I'm going to be looking at. And some may take longer to get there than others. Usually I'm going to hold it for 3 years. I'm coming up on a couple of them right now that are more than 3 years old. And I'm going to look, do I want to continue to hold it or do I want to get rid of it? So it's just giving you guys an opportunity right now. I still love NVIDIA. I think NVIDIA is still a kick-ass company. But back when we were buying it, Merlin, right in the 30s, just understand that since the split right now, and it's split 4-1 back in 2021, our cost basis per share on NVIDIA, which as of Friday was $212 a share, is $7.84. This is why Warren Buffett doesn't lose sleep. Unless this company implodes itself, even if the market corrects again, to get back down to a $7 stock, you have to go ahead and say, look, Maybe you're going to miss this one, but are you going to keep missing some things?
Well, I think the important part with that, Larry, is, odds of it getting down to 7, there's always that chance, but you're also, by buying these companies based off of the fundamental valuations, you're looking at the numbers, but you're also looking at the business itself, right? And NVIDIA clearly was a leader back in the graphics card days, and now they're really pushing heavily for the AI. If you look at most of the artificial intelligence ETFs that are constructed in the United States, so you just bring up any of the ticker symbols for them, NVIDIA is generally in those AI portfolios because the chips and the technology they're using is really kind of being tailored towards AI, which of course is just starting to boom. So now, that might be, a whole new revenue stream for NVIDIA going forward, and it could vault them to even higher highs. So the odds of getting back to 7 are incredibly slim, but nothing is impossible. And I think
no, absolutely. But again, the chances of that happening, it would have to be something very cataclysmic, either to the company or to the actual markets, for that to really drop again. And it's just interesting to know that even back when, that's why Warren Buffett wasn't freaking out during the tech bubble or the housing bubble. If anything, remember, he was buying during that time because he knew what to look for. So again, my thing about options, I trade options. I like investing in them. I like trading stock if it makes sense. It's about putting something together based on your personal plans of how you want to manage your money going forward. The question is, when the mighty V hits again, are you going to be in a position to take advantage of it from both sides? Or you'll go back and say, well, missed 2020. Maybe the next one will come. Who knows when that's going to happen? Yeah. Either way, don't really care. Just waiting for it, and I'll see it, and I'll take advantage of it.
Nice. Well, Larry, your upcoming schedule, what does it look like? I know you've got some focus series coming up, and for anybody here, if you'd like to know more about the focus series, you can just go to tradingacademy.com, go to their webpage, and find out more info. But what's your teaching schedule look like? You got any classes coming up?
Yeah, I basically do, which I love. I'm just going to stop sharing for a quick sec. There we go. So what I basically have right now is I've got the trade plan class. One of the things I did about 2 years ago was I went back and rewrote the class. I felt there was more that needed to be done. And I introduced, I don't know if some people here took the class, but I introduced a goal setting calculator. A lot of times students don't really know what they need, or more importantly, there's a 3-piece puzzle to position sizing. Maybe that's another show we could do that I'm really adamant about. Is it's not just how much you're risking per trade, but how much you're going to allow yourself to tie up on a trade.
Right.
And then more importantly, what do you need to even put on the trade? And I see people just trading for the sake of trading, not being strategic about it, and then wondering why they can't make their goals monthly or annually or even quarterly. Mm-hmm. And then I'm also teaching the Trading Weekly Option class on March 1st. So those people who are going to come in, I teach that class live online. It's a 1-day class. And then every Saturday morning, we get together. And what I do is I'll actually go through my trades of the week. And I give a lot of commentary about what I liked, what I saw, why I did what I did. And a lot of students now are starting to pick the same strikes that I'm picking, which I love. Like the thing I want more than anything else, Merlin, I know you're the same way, is getting to a point where our students become successful. They're teaching it to their kids. And it's just something that they like doing every day. It doesn't feel so much like work anymore. So those are the 2 big things I'm doing. And then I'm teaching, I think, an options class in Woodland Hills in March. Nice. So I'll be up there for 7 days. Yep.
Excellent. Well, thank you, Larry. It has been a long time. I know you had some scheduling conflicts, so I appreciate you jumping in here last minute to do the session today. Always a pleasure. And maybe I'll try to get you on next month if I can book a slot in your schedule that doesn't get taken away.
There you go. Hey, it's great to be here with everybody. I love what you're doing, Merlin. Keep doing what you're doing. And guys, be safe. Have a great 2023. That's the important thing here.
Awesome. Thanks, Larry. I'll talk to you soon.
Hey, bye, guys.
Guys, Larry Jacobson of Online Trading Academy giving little insights into, I called the page out of Warren Buffett's Playbook, because obviously Warren Buffett does so many different things. But, we talked a little bit about the option side of things, just the shorter term, and then also the fundamental analysis part. And it strikes me as odd that the industry really focuses on Buffett's ability to pick great companies. And if you look at the actual statements, he's making more money selling options than he actually is making on the underlier of his company. So good stuff there. Is that why he's no longer teaching the options class? I think he's still teaching options classes. There's other people that teach. So, they're kind of rotating through the different instructors. Let's go. Rob, you sent in a question, said, there's a good one. if the fundamentals say that price should be X, then why does it trade at Y? This is human behavior, right? This is all about human behavior, psychological analysis. And in my opinion, Rob, a lot of it has to do with just outright manipulation by companies. And what I mean by that is you can have a company issuing upgrades and upgrades and upgrades, or downgrades and downgrades. They're doing it all the time. There's always upgrades and downgrades going on. When price gets out of balance, quite often it's being pushed that way for the agenda of somebody else. And that could be because someone's issuing press releases saying this company's terrible. Maybe it's just fallen out of favor and the industry kind of keeps pushing in that vein, kind of pushing that price down. But I think this is where Larry's strategy and Bashir's strategy that's taught at OTA, which is different than the value line one time I've seen. There's definitely similarities in fundamental analysis, but the formula, that spreadsheet that they built out, has specific criteria to look for. Ultimately, you're looking at that as the determination of, is this a good buy? So it's kind of different than what I would look at, which is I'm looking at price, right? I'm looking at price action, and I personally don't care about fundamentals, but that's my approach, and I am not a long-term investor except for crypto, right? Crypto, I am a long-term investor. But with individual securities, like I'm not going to hold NVIDIA for 5 years. No way, not a chance. I personally would rather be active in trading it and selling options on it, or just even short, going long, going short that one. I would certainly be much more active in my trading, but that's just me. Some of you are much more relaxed. Hey, I'll just hold this one because I love it. And I think the value perspective of it really does create some great opportunities, and also removes a lot of the emotion, because you're basically looking at the numbers that they've released, seeing the trends, and saying, okay, if this is 25% below where it should be, well, that's a good deal for me. Or maybe it's at that level and you say, I'll start selling some puts against this and generate some great premium at these levels. And if I don't get it, fine. If I do, I've already bought it at a 25% discount plus all the premium that I'm collecting. So I think it's a novel approach, not as new, but it's just an interesting approach. I think a lot of people don't really focus on. Value investing has been around quite some time, but I think the way that they teach it is a bit unique. So there we go. There was another question there. I think that was it. Sorry, Robert, I didn't get a chance to answer your question. And there was another, I think, Robert, maybe you sent the one into my email, which I didn't get a chance to get to Larry out there today. I apologize. I will do my best to get that question answered next time Larry comes on, which is more of a longer term focus. So let me real quickly, as I got 2 minutes here to make this a 1 hour show. Here's what happened out there today. Obviously, you guys know what happened. Now, retail sales numbers came in much higher than expected. It was expected to go from negative 1.1 to a positive 1.9. Came out at 3.0. Goodness gracious, that was kind of from left field, and that is really what helped these markets vault to the upside. You had a pretty nice day. Here's your daily of the NASDAQ. Let's go like a 15. Just so you can see, right from the open, just kept on rallying. It was that news came out and just was up Periscope all day. Most of the major market indexes were up on the day. Gold was down 1%, crude oil down 0.59%. But really the story right now is Bitcoin. What on earth is going on with Bitcoin? Just starting to fly. I took some losses today on my puts on the NASDAQ. I took some losses on my options on Boyle, and I more than made up for all of that with my crypto holdings today, which just went absolutely gangbusters, 8.75% as of right now. So that's the day that, as we see it. Now for tomorrow, here are two things to pay attention to for the upcoming, wow, I'm doing Monday Morning Must-Knows live on the show today. Here is your information for tomorrow. Big day. So CPI came out on Tuesday, and that was much better. Well, I guess you can't say much better. Depends how you look at it. It was higher than anticipated. And PPI comes out tomorrow, again, 1 hour before the markets open. That could be a very big catalyst for the markets as well. So you have three pretty volatile news releases, Tuesday, Wednesday, and Thursday. Good news for you is Friday should be kind of quiet, but you see you've got PPI numbers, Philly Fed manufacturing index numbers. The Empire came out today, which was better than expected, but still negative. You have unemployment claims, building permits, housing starts, mortgage delinquencies. It is a plethora of stuff coming out for the U.S. Now, for Rob over in the U.K., you do have for retail sales numbers coming out for the British pound tomorrow, which is, of course, one that might drive these markets. That's going to happen at 11 p.m. tomorrow night. That is Eastern Standard Time. So that, my friends, is your trading show for today. Did I make it out in under an hour? I did not. We are over an hour today. So Tom, it was here at the very beginning. I think he might have left. So tomorrow, I'm going to have Sean Reed on the program. As Larry mentioned, he does this thing, peddling for premium. He does a lot with Vega and just selling premium and collecting that and generating income streams. And I haven't had him on for quite some time. Love the guy. He's just a great trader, and I love his approach. He's just a machine with regards to his methodology, and hopefully that will convey on tomorrow's program. So we'll have Sean reading the program tomorrow. Friday, I'll get to all the questions that I have been missing. What's my thought on my estimate on PPI? Well, I was wrong on retail sales, and I was wrong on CPI. Retail sales completely just made me go, what? How do you have such a huge number unless there's reporting not happening for November and December? Those were the big months, and they were negative. Now all of a sudden, here we are in January, and January's number is really super positive. That's so bizarre to me. I was wrong on CPI because I thought it would be 6.5, or sorry, I thought it'd be 6.4. It was, at least for the month, 0.5, and I thought it would be 0.4, came out at 0.5. So I was wrong there. Given the fact that you're seeing the CPI number was a little bit higher than expected for the month over month, I think that will probably be the case here. So you notice the PPI is expected to go from negative 0.5 to 0.4. My guess is you'll probably come out at 0.3 or 0.2. Most likely 0.3 would be the number that I think will hit. So there you go. But it doesn't really matter if I'm right or wrong on my estimate. It's just based off what I see with the other news. We will see tomorrow how it all pans out and trade accordingly. So that said, again, I hope you enjoyed having Larry on today. A little bit of look at short-term options as a whole, and then looking some of the fundamental side of things. If you are interested in taking any classes with Larry Jacobson or Bashir Chaya, which has a fantastic class on value investing, you can find out more information by going to tradingacademy.com. Their website will have all that information. And I guess as a bonus for me, if you do to look at any of those things, just tell them you found out about it on TraderMerlin. Huh? Give a little plug for my show. Anyway, thank you guys so much. Hope you enjoyed it. If you did, give me a thumbs up. If you're new, hit that subscribe button. I will see everybody for our PPI special show tomorrow. I'm hoping the graphic I created with my AI will do it justice. I might have to redo it if the numbers come out different, but I will see you guys all tomorrow. Take care.